Okay, let's unpack this. Imagine we have the power to actually edit life itself, to fix diseases by going right into our genetic code and making a precise change.
It sounds like science fiction almost.
It really does. But that's the revolutionary promise of gene editing. And the company we're diving into today, CRISPR Therapeutics, ticker CRSP, they're right at the forefront. Pioneers. They've achieved something massive. The first ever approved therapy using CRISPR technology called Cas9.
A truly landmark achievement, no doubt about it.
But here's where it gets, well, really interesting for us as investors. If they've hit this huge milestone, a medical first, why is their stock trading so far below its all-time high? What's actually going on there?
Yeah, that's the million-dollar question, isn't it? Or maybe billion-dollar, given the potential.
Exactly. So that's the core question guiding our deep dive today. We're looking closely at the stack of sources you've shared on CRISPR Therapeutics AG. This is all as of late May 2025. Our mission, to get beyond the headlines, sift through this material, and really pull out the key knowledge. We want to understand CRSP's business, their management, the financials, how the market sees them, the risks.
And importantly, what it all means from a value investing perspective for you, the listener.
Exactly. Through that value lens.
It feels like the market is really wrestling with this, doesn't it? You have this incredible scientific potential clashing with the very real practical challenges of making it a profitable business.
That's a great way to put it. It's the classic biotech story, but maybe amplified because the tech is so cutting edge.
Totally amplified.
And hey, if you find this kind of deep dive valuable, exploring these complex companies with us, you might want to check out Stock Analytics AI. Subscribing to the Stock Analytics AI YouTube channel is a great way to stay updated.
Yeah, we cover a lot of ground.
We do. And for Euro $4.99 a month, members can actually submit a ticker symbol for a prioritized deep dive or earnings analysis. It's a neat way to get your questions looked at sooner. You can find links to the sources we're using today in the description, by the way. Okay, let's start with the basics, the science. At its heart, what exactly is CRISPR and what is CRSP built on?
So the core is the CRISPR-Cas9 gene editing system. The simplest way to think about it is like having incredibly precise molecular scissors.
Okay.
You can find a specific spot in the DNA, like a typo causing a disease, and make a cut. Then you can potentially correct it, fix the underlying genetic problem.
And the scientific credibility here is massive.
Oh, absolutely.
Right.
One of the co-founders, Dr. Emmanuelle Charpentier, actually won a Nobel Prize for her work on CRISPR. That tells you something about the foundation.
That Nobel link is powerful. But, amazing science doesn't automatically make a great business, especially in biotech. You need protection. How's their intellectual property? Are they building a decent moat?
That's crucial. Protecting the tech with patents is key for any kind of long-term advantage, or moat. The sources mentioned they had around 232 active patent applications for gene editing back in 2022, focused on key places like the US and Europe.
So, a decent number.
It's significant, yeah. But the CRISPR IP landscape is, well, it's a battlefield. Really competitive, lots of lawsuits. One source noted that while CRSP is a major player, they were actually ranked 5th in patent grant share among some key competitors in 2022.
Okay. So they have patents, but it's a credit fight.
Exactly. They have a position, but the race for IP dominance is definitely ongoing. It's complex.
Got it. So they have the tool, they're fighting to protect it. What are they actually using this tool for? What's in their pipeline?
Well, the pipeline is pretty broad, actually. They're targeting a whole range of serious genetic diseases. If you look at summaries like the one in Table 2, you see programs for blood disorders. That's where KETI-UY fits in. But also cancer, cardiovascular disease, and others. It shows they're trying to apply the platform tech across different areas.
Okay, let's zoom in on the big one then. CRSP, this first approved product. Tell us more.
Right, CRSP, or Exaccel, as it's also known. It's the landmark achievement, co-developed with Vertex Pharmaceuticals, and it's approved in major markets, US, EU, UK, for 2 serious blood disorders, sickle cell disease, SCD, and beta thalassemia, TDT.
And how does it work? You mentioned molecular scissors.
Yeah, but this is what's called an ex vivo therapy. Ex vivo means outside the body.
Okay.
So they take the patient's own stem cells out, send them to a special manufacturing facility, use CRISPR to edit those cells, and then infuse the corrected cells back into the patient.
Wow, that sounds complex.
It is complex, definitely a process.
So how's the launch going? Is it taking off?
Well, the launch is underway, but it's still early days and, like you said, complex. As of early May 2025, they had over 65 authorized treatment centers set up globally.
Okay, that's quite a few centers.
It is. And a key metric mentioned was that about 90 patients had actually started the process, undergone cell collection by May 1st, 2025. They're also making progress on reimbursement, which is absolutely critical for such a high-priced therapy.
High-priced, right?
Yeah. They even set up an interesting outcomes-based agreement with CMS in the U.S. for Medicaid patients, payment tied to how well it works over time.
That's innovative. And the Vertex partnership, how does that affect CRSP's bottom line?
That's super important. Vertex is leading the commercialization globally. They handle the sales, marketing, dealing with hospitals, payers.
They have the infrastructure.
Exactly. They have the muscle for a complex launch like this. Now, critically, the costs and, importantly, the profits from KSTAV are split. 60% goes to Vertex, 40% goes to CRISPR Therapeutics.
Okay, 60-40 profit split.
Right. So Vertex takes on a lot of the launch risk and effort, which is good for CRSP in a way, but CRSP only gets 40% of the profit after all the costs are taken out, not 40% of the total sales number.
Got it. So Vertex reported, what, $13.2 million in CASTV sales in Q1 2025?
Yeah, but CRSP's share of the profit from that would be much smaller, especially with all the launch costs eating into it initially.
Makes sense. Okay, beyond CSGVY, what else is exciting in their pipeline? What should we be watching?
Two key areas really show where they're heading strategically. First, in cancer, they're working on something called allogeneic CAR-AT therapies.
Allo what now?
Allogeneic. So traditional CAR-T therapy is highly personalized. Take cells from a patient, engineer them, give them back only to that patient. Very complex, very expensive.
All right, I've heard of that.
Allogeneic means using cells from healthy donors. The goal is an off-the-shelf CAR-AT product. One batch could treat many patients. Potentially much simpler manufacturing, easier logistics.
Ah, okay. Off-the-shelf cancer therapy. That sounds like a big deal.
It could be. They have CTX112 for blood cancers and autoimmune diseases. That's in phase 12 trials. And even has a special RMAT designation from the FDA for some lymphomas, which could speed things up. And CTX131 for solid tumors and other blood cancers also in trials. We should get updates on those this year.
And the second key area.
The second is in vivo editing. This is kind of the holy grail.
In vivo, inside the body.
Exactly. Delivering the CRISPR machinery directly into the patient to do the editing right there, inside the target cells. No need to take cells out and put them back.
How do they deliver it?
Right now, they're mainly using lipid nanoparticles, tiny fat bubbles, essentially to carry the CRISPR tools, primarily targeting the liver.
Okay.
They have CTX310 targeting AGPTL3 for cardiovascular disease. Early phase 1 data looked positive. Reduced triglycerides and LDL cholesterol seemed well tolerated. We're waiting for the full data later in 2025. And CTX320 targets another heart risk factor, LPA. That's also in phase 1, with data expected pretty soon in Q2 2025. Plus some earlier programs for things like hypertension using this in vivo approach.
Wow. So this shift to allogeneic CAR-T and in vivo editing, that sounds strategically massive compared to the complex cancer GY model.
It really is potentially transformative. The CATCH-GVY ex vivo process, like we said, it's complex, needs special centers, patient conditioning, long manufacturing times. In vivo and allogeneic therapies could be much simpler to administer, maybe just an infusion.
Reaching way more patients.
Exactly. Potentially reaching more patients, being more scalable, and hopefully having lower manufacturing costs per dose down the road. Success here could open up much bigger markets and a simpler business model.
And are they still partnering up beyond Vertex?
Oh yeah, collaborations are definitely a core strategy. We talked about the huge Vertex deal. There was also a joint venture with Bayer called Casabia, working on hemophilia A, though we'd need the latest filings to confirm the current status.
Okay.
And a newer one, just announced in May 2025, is with CRISPR Therapeutics. That's on siRNA therapies, a slightly different approach to genetic medicine. Interestingly, as part of that deal, Sirius actually invested $70 million directly into CRSP, buying shares.
A $70 million equity investment. That's a vote of confidence.
It seems like it. Plus, they have other partnerships with academic groups and smaller biotechs like Nkarta and Capsida.
So they're in this groundbreaking space, but it sounds crowded. What's the competitive landscape really look like?
It's intense and dynamic. The whole gene therapy market is booming, projected to potentially triple to over $30 billion by 2030. The CRISPR-specific part is also growing fast.
But CRSP isn't alone.
Not by a long shot. You have direct CRISPR competitors like Intellia, Editas, but critically, you also have companies developing newer gene editing tools that could challenge CRISPR-Cas9.
Newer tools like what?
Things like base editing from Beam Therapeutics or prime editing from Prime Medicine, these aim to make changes without cutting both strands of the DNA, which some think might be safer or more precise in certain cases.
So the tech itself is still evolving fast.
Extremely fast. And then you have companies using older tools like ZFNs, like Sangamo. The key takeaway is, while CRSP got the first CRISPR approval with Casgevy, the technology race is far from over. Their moat isn't just about having CRISPR-Cas9, it's about executing on Casgevy and staying ahead with these next-gen platforms like in vivo and allogeneic, all while navigating this crowded IP space.
Okay, let's bring it back to that value investing lens. How does this business stack up against, say, classic Buffett principles? Is it understandable? Does it have favorable long-term prospects and a real economic moat?
Well, the mission curing genetic diseases is incredibly compelling and understandable, right?
Absolutely.
The underlying science is complex, no doubt, but the goal is clear. Favorable long-term prospects. Potentially huge if Casgevy succeeds commercially and the pipeline delivers, especially those potentially simpler platforms.
But the moat.
That's the tricky part. It's nascent. It's based on being first with Casgevy, their IP portfolio, their platform tech. But like we said, it's being actively challenged by rapid innovation from competitors using CRISPR and these newer editing tools. It's not a wide, stable moat like you'd see in, say, a dominant consumer brand. Not yet, anyway.
Okay, so who's actually steering this ship through these choppy scientific and market waters? Let's talk about the leadership.
The CEO is Dr. Samarth Kulkarni. He's been in charge since late 2017. Before that, he was chief business officer, so he was involved in those early crucial deals like the Vertex partnership.
But you've seen it develop.
Yeah, he's overseen the whole journey to getting Casgevy approved and expanding the pipeline into these newer areas like in vivo and allogeneic CAR-T.
What about his compensation? Does he have skin in the game?
His total compensation reported for 2025 was quite high, around $33 million. But the vast majority of that, almost 98%, was in equity and bonuses, not base salary.
Okay, mostly performance-based.
Right. And his direct share ownership was about 0.33%, worth roughly $10.3 million in early 2025. Now, from an investing standpoint, high equity comp can align interests with shareholders, which is good.
Right.
But the sheer size of that compensation package for a company that's still losing money, that's something value investors would definitely scrutinize very closely. Is it justified at this stage?
Fair point. What about the team around him? Tenure.
The average tenure for the core management team is around 5.6 years, which suggests a decent amount of stability there.
And the board. Who's providing oversight?
The board seems well suited for a biotech. You've got people with strong scientific, medical, and business backgrounds. Names mentioned include Dr. Douglas Trecco as the lead independent director and Dr. Catherine Hai, who's a real pioneer in gene therapy herself.
So relevant expertise.
Definitely seems like it. Average board tenure is similar to management, about 5.9 years. And there was one interesting tidbit regarding insider confidence. Director John Green bought about $313,000 worth of shares back in February 2025.
Okay, some insider buying. How are they allocating capital? Where's the money going?
Overwhelmingly, it's going into research and development. That's the engine of the company right now, trying to turn that science into more therapies.
And where does the money come from?
It comes from their cash reserves, upfront payments, and milestones from partners like Vertex and now Sirius, and also by selling new shares to raise capital. They did a $280 million equity offering early in 2024, and that recent share issuance to Sirius was another form of equity financing.
Right. Dilution risk there.
Potentially, yes. The collaboration model, where partners share costs, like with Vertex, also helps manage capital needs for specific programs. The big question for investors is this heavy R&D spending rational? Is it likely to generate enough future return to justify the cost and the dilution?
Tough question to answer definitively right now. What about candor? Are they upfront about the challenges?
Well, public communications, press releases, presentations naturally tend to focus on the positives, the progress. That's normal. To really judge candor, a value investor needs to dig into the detailed SEC filings. Look at the risk factors section. Read the management's discussion and analysis, or MD&A. How frankly do they talk about the hurdles? The CRSP launch complexities, the tariff risks, the competition. Real candor means acknowledging the difficulties alongside the successes.
Okay, let's dig into those financials now. What does the history tell us?
Well, the clearest takeaway from the numbers, like in Table 3, is that this is very much a pre-commercial or very early commercial stage company. They aren't profitable, and they don't have consistent product revenue yet.
Yeah, I noticed the revenue jumps around a lot. Why is that?
That's entirely driven by those collaboration payments we talked about. Big milestone payments or funding tranches can cause huge swings. Like revenue was way up at $371 million in fiscal 2023 because of specific collaboration events, but then dropped right down to $37 million in 2024.
Wow, big difference.
Huge. And Q1 2025 revenue was tiny, less than $1 million, mostly from grants. It shows there's no stable growing sales base yet. And remember that CSGVY structure Vertex books the sales. CRSP gets 40% of the profit. So even with $14.2 million in Q1 sales from Vertex, the actual profit share flowing to CRSP is much smaller, especially early on with high costs.
Right, and the bottom line reflects that, consistent losses.
Exactly. Consistent net losses. They lost around $366 million in fiscal 2024, and the loss in Q1 2025 was $136 million, which was actually more than the loss in Q1 of the previous year.
So losses are widening, not shrinking, at least in that comparison.
In that specific quarter-over-quarter snapshot, yes. It highlights that the path to profitability is still quite a way off and depends heavily on future success.
Where is all the money going? What are the main expenses driving these losses?
It's primarily operating expenses, and the biggest chunk of that is R&D research and development. That was $72.5 million in Q1 2025 alone. Then you have G&A, general and administrative costs about $19 million in Q1. And importantly, collaboration expenses were $57.5 million in Q1. That's gone up as they share costs for CSGVY and push forward with the in vivo programs.
So they're definitely burning cash. Do they have enough in the bank to keep the lights on?
That's actually a key strength right now. They have a very strong cash position. As of the end of March 2025, they had about $1.86 billion in cash, equivalents, and marketable securities.
$1.86 billion. That sounds like a lot.
It is a solid cushion. Their working capital is also strong, around $1.85 billion at the end of 2024. And their debt level is pretty manageable compared to the cash they have.
How fast is that cushion shrinking? What's the burn rate?
Well, the overall cash balance went down by about $48.5 million in Q1 2025. But if you look just at cash used in operations, that was higher, around $116 million in that quarter.
So a significant operational burn.
Yes. That $1.86 billion gives them a good runway to continue funding R&D in their share of the STIR-VY launch for a while. But how long a while is depends entirely on that burn rate, how quickly STIR-VY revenues and, more importantly, profits ramp up, and whether they hit milestones from other partnerships.
We keep coming back to R&D spending. What's the ultimate financial goal there?
It's all about translating that science spending into actual products that sell and make money beyond just STIR-VY. It's an investment trying to build future earnings power, hopefully leveraging those potentially more efficient platforms like allogeneic or in vivo down the line.
What's the outlook? Are analysts expecting profitability anytime soon?
Analysts are projecting a pretty steep ramp in revenue. They're estimating maybe $42 million for all of 2025, but jumping significantly to over $250 million for 2026.
Okay, that's a big jump.
It is. But even with that projected revenue growth, they're still expecting losses per share to continue for the next couple of years. Maybe a loss of $5.55 per share in 2025, improving slightly to a loss of $4.07 in 2026.
So still losing money, despite higher revenue forecasts.
Right. And there's this tension, these steep analyst projections versus the actual slow start for Casgevy sales reported by Vertex, $14.02 in Q1. Reaching profitability really hinges on Casgevy taking off much faster, becoming profitable quickly, or them hitting some major milestones in the pipeline, or signing new big deals.
Okay, stepping back again to the value investing perspective, how do these financials fit?
They really don't fit the traditional mold at all. There's no predictable earnings, no consistent free cash flow the cornerstones value investors usually look for. The prudence here is purely in that strong cash balance, which buys them time. But investing in CRSP today is fundamentally a bet on highly uncertain future financial performance, driven entirely by R&D success and commercial execution. The value is all potential, not current reality.
And this financial picture, combined with all the business complexity and risks, it really starts to answer that first question we had, doesn't it? Why the stock isn't higher, despite the Casgevy approval.
Exactly. There's just so much uncertainty the market is trying to price in. We should probably dig into how the market is actually viewing all this uncertainty next.
Welcome back to the Deep Dive. We've covered CRSP's business, management, and shaky financials. Now let's check the market's pulse. What are the Wall Street analysts saying?
Well, the general consensus among analysts covering CRSP tends to lean positive, often averaging out to a buy rating.
Hmm.
Sources suggest somewhere between 31 and 35 analysts are following it, with maybe 40–55% having a buy or strong buy.
Okay, generally positive.
But, and this is a big bite, when you look at their price targets for the next 12 months, you see something really striking. Massive dispersion.
Dispersion, meaning they don't agree.
Exactly. The range is incredibly wide. The middle of the road or median target might be around $75 to $82, but the lowest targets are way down at $32, while some high targets stretch up to $112 or even higher outliers.
Wow, that's a huge range.
It is. Just looking at some examples from May 2025, H.C. Wainwright had a $65 buy, but Barclays was way lower at $42 with an equal weight, basically neutral. Goldman Sachs was also neutral at $47. Then you had Needham and Chardon Capital as buyers around $81, $82. This huge spread is critical. It basically screams uncertainty. The analysts can't agree because the potential outcomes are so varied. How well will Casca-VY actually sell? Will the pipeline drugs work? How will competition shake out?
It reflects those binary outcomes you mentioned earlier.
Precisely. It signals that the market views this as a high-risk, high-reward situation. The price targets reflect wildly different assumptions about whether things go really well or not so well.
And speaking of anticipating big moves, what's the options market saying about volatility?
Yeah, the options market is definitely pricing in some significant swings. There's more activity in call options than puts, which might hint at some underlying bullish bets or maybe just hedging activity. But the key indicator is implied volatility. Right. For near-term options, it was running quite high, around 59% in mid-May. High FI means the market expects the stock price to move a lot up or down. For investors, it confirms this is a volatile name, probably not suitable for the faint of heart or risk-averse.
What about the short sellers? Are people actively betting against CRSP?
Yes, and it's a pretty significant factor here. Short interest has been notably high and persistent. As of late April 2025, something like 21 million shares were held short.
21 million shares shorted. How does that compare to trading volume?
Depending on the volume period you use, it translates to roughly 13.5 to almost 15 days for all those shorts to cover their positions if they wanted to buy back the shares. And it represents a big chunk of the publicly available shares, around 25% of the float.
That's quite high. What does that signal?
It signals significant market skepticism about the current valuation. These short sellers likely see major obstacles: the CRSP launch challenges, the long path to profitability, the competitive threats, maybe concerns about the technology itself.
So a bearish view from a decent chunk of the market.
Exactly. Now, sometimes high short interest can fuel a short squeeze if good news hits unexpectedly, forcing shorts to buy back quickly and driving the price up. But fundamentally, its presence reflects a strong negative conviction from a noticeable segment of investors.
Okay, so you've got no profits, analysts all over the map, high volatility, lots of short sellers. How on earth does a value investor even start to think about intrinsic value here?
Honestly, using traditional methods, it's incredibly difficult, maybe impossible. Things like PE ratios are useless without earnings. Discounted cash flow models need predictable future cash flows, which CRSP just doesn't have.
Right.
The value here is entirely tied up in probabilities. What's the chance this trial succeeds? That drug gets approved. That it captures X% of the market against competitors Y and Z. You have to make huge, highly speculative assumptions.
So finding a traditional margin of safety is tough.
Extremely tough, because the intrinsic value itself is a wildly uncertain estimate based on dozens of unknowns. It forces you to rely much more heavily on qualitative factors. How good is the science, really? How capable is this management team? How big is the unmet need? How strong are the barriers to entry beyond just the current patents? It's a different kind of analysis.
Let's shift gears slightly and look at who actually owns the stock. What does the ownership structure tell us? Are institutions heavily involved?
Oh yes, institutional ownership is very high. Sources suggest it's around 97% of the shares. If you exclude insiders and strategic partners like Vertex or Sirius, we're talking over 550 institutional owners.
80 big names.
Yeah. Major players like ARK Investment Management, Capital International Investors, T. Rowe Price are listed among the top holders.
ARK is interesting. What does their presence suggest?
Having prominent growth funds and biotech specialists like ARK involved signals that a lot of institutional money sees that huge long-term disruptive potential in CRISPR technology and CRSP's role in it. ARK was even noted as adding shares recently, around May 2025. Capital International also reportedly increased their stake in Q1.
So confidence from some big players.
Definitely confidence in the long-term vision. But the flip side is that high ownership by funds known for momentum or thematic investing, like ARK, can also make the stock more volatile. Big shifts in their sentiment can really move the price.
Makes sense. What about the insiders, the CEO, the board members we talked about? How much do they own, and have they been buying or selling recently?
Well, we mentioned CEO Kulkarni's stake is relatively small, around 0.33%, worth about $10 million earlier this year. The main recent insider transaction highlighted was Director John Green's purchase back in February, about $313,000 worth.
Any significant selling?
The sources we looked at for May 2025 didn't flag any major open market selling by insiders.
So what's the takeaway? One buy, no major sells. CEO stake is okay, but not huge.
Yeah, it suggests maybe insiders aren't rushing to buy hand over fist at current prices, even if they aren't selling aggressively either. The absence of selling is mildly positive, perhaps, but it's not the strong signal you'd get from widespread, significant insider buying. And remember that Sirius share purchase was part of a strategic deal, not an insider buying stock on the open market because they think it's cheap.
We've touched on risks all along, but let's try to consolidate them. What are the biggest potential potholes for CRISPR Therapeutics?
The risks are definitely significant, and they come from multiple angles. One specific external factor mentioned in the sources is the potential impact of new U.S. tariffs expected in 2025.
Tariffs. How would that affect a biotech company?
Well, the exact scope, especially any exemption for pharmaceuticals, wasn't totally clear. But the biotech industry relies heavily on global supply chains. Something like 90% of U.S. biotechs use imported components. Tariffs could hike costs for crucial things like raw materials, specialized lab gear, manufacturing equipment.
And CRSP specifically, they're Swiss American, right?
Exactly. With operations in both places and plans for U.S. manufacturing, tariffs could directly inflate their operating costs. Given they're already losing money, anything that strains the R&D budget or delays profitability is a negative. The sources mentioned potential impacts on materials or equipment coming from Europe, China, India.
So another layer of uncertainty and potential cost pressure.
Precisely. Even if they get exemptions or mitigate it somewhat, it's a risk factor to watch. But beyond external things like tariffs, the inherent risks of drug development itself are just massive, especially for gene therapies.
Like clinical trial failures.
Exactly. Navigating the complex regulatory pathways with the FDA and EMA is tough, and they aren't always aligned. Plus, there are long-term commitments like the FDA wanting 15-plus years of follow-up data for these therapies. But the biggest risk is simply that the pipeline drugs, CTX112, 131, 310, 320, the others might fail in trials. They might not work or have safety issues or face long delays. The failure rate in drug development is notoriously high.
We talked about the slow start for CSUVY sales. Is market access still a big risk?
Absolutely. Getting a brand new, super expensive, complex therapy like CSUVY adopted is a huge challenge. Identifying the right patients, educating doctors, managing the whole ex vivo logistical process, and crucially, getting payers to consistently reimburse it. These are major hurdles. The slow initial uptake confirms these aren't trivial issues. Manufacturing is another one. Making these cell and gene therapies is technically really difficult and costly. Vertex handles KHGY, but CRSP is building its own capabilities for the allogeneic programs. And just relying on specialized global suppliers for materials makes the whole supply chain vulnerable, even without tariffs.
And then the competition we keep mentioning.
Yes, the intense competitive pressure, not just from other CRISPR companies, but critically from those newer editing technologies like base and prime editing that might, down the road, offer advantages and erode CRSP's edge. Plus, direct competition for specific diseases like CTX310 for heart disease will face other existing and new drugs. And that whole complex, litigious IP landscape is an ongoing risk.
Okay, and finally, summing up the financial risks.
It boils down to a history of significant losses and negative cash flow, a high cash burn rate that, despite the current cash pile, likely means they'll need more funding eventually, bringing dilution risk, and high stock price volatility, as shown by the options market and analyst spread. High risk, high uncertainty financially.
Okay, let's try to wrap this all up. We've covered a lot of ground in this deep dive. What's the overall picture of CRISPR Therapeutics based on these sources, especially through that value investing lens?
Well, CRST is undeniably a pioneer. They have a major scientific achievement with Cascavity's approval and a broad, potentially exciting pipeline, especially with the shift towards possibly more scalable platforms like allogeneic and in vivo.
All right.
But they operate in a highly speculative, incredibly complex, and very risky environment. From a traditional value investing standpoint, it just doesn't fit the mold. There are no predictable earnings, the economic moat is still being built and is under constant attack from competitors and new tech, and the future financial performance is massively uncertain. An investment here is a bet on potential, not on proven, stable performance.
Which brings us right back to where we started, that hook question. If they achieve this incredible scientific first with Cascavy, why is the stock so far off its peak? What's the answer, based on everything we've discussed?
The answer is that the market's valuation isn't just about the science, as amazing as it is. It's grappling with the messy, difficult realities of turning that science into a sustainable, profitable business. The current valuation reflects the huge execution risks involved.
Like the Cascavy launch.
Exactly. The slow, complex Cas9-VY launch, the intense competition, including from potentially better technologies down the line, the difficulty and cost of manufacturing, the long, uncertain, expensive road for the rest of the pipeline candidates, potential external pressures like tariffs. All these things create enormous uncertainty about future earnings power.
So the peak price was maybe peak optimism on the science, and the current price reflects the hard realities of business.
That's a good way to think about it. The peak likely reflected the wow factor of the pure science, while the current price is trying to factor in all the practical difficulties, competitive dynamics, and execution risks on the path to actually making money from that science.
That makes a lot of sense. It clarifies the gap between scientific breakthrough and business success.
Yeah, that journey from the lab bench to reliable profits is often long, winding, and full of obstacles, especially when you're right at the bleeding edge like this.
Okay, so here's a final thought for you, our listeners, to mull over after this deep dive. Considering the genuinely transformative potential of gene editing and CRSP's pioneering role in it, is the current stock price mainly reflecting those undeniable inherent risks in the science and the tough path to commercialization? Or could it represent a potential opportunity if their next-generation platforms, the in vivo or allogeneic therapies, actually achieve breakthroughs and offer a much more scalable, simpler path to market than the complex CSGVY model?
That's the core question, isn't it? Weighing the known challenges against that vast, uncertain, but potentially enormous upside.
Definitely something to think about. And if you want to keep exploring complex companies and these kinds of questions with us, please make sure you're subscribed to the Stock Analytics AI YouTube channel. And remember, members at the Euro 4.99 level can suggest tickers for prioritized deep dives.
And just a reminder, this deep dive was based solely on the source materials provided. It's for informational purposes, driven by AI analysis of that data, and it is definitely not financial advice. Investing in biotech, especially gene editing, is highly speculative and carries substantial risk.
Absolutely. Thanks for joining us for this deep dive.